Hello friends, welcome to the June edition of Monthly Viewpoints. The Indian equities witnessed a rally in the month of May on the back of a strong mandate for PM Modi in the general elections. However, global equities witnessed a sell-off due to weak macroeconomic data and deteriorating sentiment on the trade disputes. With the election-related uncertainty behind us, let us address the key questions on investors' minds now, namely, is there a risk of a long drawn-out trade war? Can we expect to see a revival in domestic growth? And what is our outlook for equities going forward? On the global front, US-China trade tensions re-escalated in May as negotiations broke down and both sides imposed tariffs on each other. Global growth is likely to slip, as is indicated in the trade and PMI numbers. In the US, the Fed is now expected to reduce rates by 50 basis points on the back of concerns regarding slowing growth and low inflation. The Chinese government is also expected to support the economy with additional fiscal and monetary stimulus. The market seems to be pricing in an extended escalation scenario wherein negotiations continue for the next few months and a resolution is hammered out by the end of the year. For India, the risk is that exports may slow this year in the weak global environment. However, a positive data point is that while some of the emerging markets have seen FPI outflows last month, India has continued to see inflows to the tune of $1.2 billion as EM fund managers continue to correct the light positioning. On the domestic front, with the general elections getting concluded, a key overhang on the Indian economy as well as the markets has been removed. It is for the first time since 1971 that an incumbent Prime Minister has secured an absolute majority for the party and has started a second consecutive term. The immediate priority of the new government will be to revive cyclical growth. India's fourth quarter FY19 GDP growth number came in at 5.8% year over year, which dragged down the full year FY19 GDP growth to 6.8% year over year, which is a 5-year low. This slowdown was likely due to the NBFC stress and liquidity issues, as well as the election-related uncertainty. With concerns on slowing growth and low inflation, the RBI has reduced its policy rate by 25 basis points and also changed its stance to accommodative from neutral, indicating that further rate cuts lie ahead. Also, system liquidity is expected to become a surplus in June post the elections. To alleviate rural distress and to boost farmer income, the government has announced that it will roll out the PM Kisan scheme to all farmers, and it's also working on measures to close the gap between the prices that the end consumers pay and what the farmers receive. It is also a pleasant coincidence that, like in 2014, when the government is starting its term, oil prices have significant decline. This should help to keep both inflation and current account deficit in check. On the investment side, private capex, which typically slows down 1 to 2 quarters before the elections, should pick up now that the elections are over. The new budget will also be announced by the government in July, post which the government capex can begin. Simplification of the GST code, increase in the direct tax revenues, and divestments are some measures which will lead to an increase in revenue and which will enable public sector capex. The $1 trillion infrastructure program of the government will be a key priority to boost jobs growth, especially in the informal sector. Coming to our view on the markets, post the election results, we saw a rally in the markets with the Nifty and the Sensex both crossing all-time highs of 12,000 and 40,000 respectively. However, although the large cap Nifty index has rallied more than 11% year to date, the mid cap and small cap indices have only risen by 1 to 2%. With confidence coming back in the markets, we believe that mid caps and small caps have room to rally further. In the fourth quarter of FY19, the Nifty revenue and profits have risen by 10% and 16% respectively, largely on the back of the financial sector. However, excluding the corporate banks, the Nifty profit has grown just 2%, and broader earnings growth for the markets remains muted. At 19.5 times 1-year forward PE multiple, Nifty valuations are at a premium to the long-term average. However, valuations for the broader market can still offer a reasonable return for long-term investors. With the election-related uncertainty behind us and a strong mandate for the incumbent government, we remain constructive on India's growth for the medium to long term. However, considering the weak global environment, we will need to see some major structural reforms and major investment programs boost India's GDP growth beyond the 7 to 7.5% range. In addition to the FPI inflows, sustenance of the domestic flows, especially the SIPs, will also be key to a revival of the broader market. In the current context, we would suggest that investors continue to build their equity exposure for the long term, especially through the SIP route. Select themes which we are participating in include consumption, which covers the consumer and consumer discretionary sectors, financials, which includes private banks, corporate banks, and select NBFCs, and industrials, which includes capital goods, cement, and select infrastructure companies. We offer a basket of equity funds for investors to choose from. Thank you and happy investing.